So for this problem, this dry cleaner is thinking about buying a new machine with a 3-year useful life and a $0 disposable price at the end of the 3 years. If they purchase the machine, they can get $100,000 for the old machine. So that's a cash inflow. They can buy a new machine for $430,000 cash outflow, but they will also incur an additional working capital expense of $100,000. So the $100,000 that you get for the old machine, less the $100,000 that you get, that you expense rather for the additional working capital expense, those two cancel each other out, and you have a net cash outflow of $430 initially if you buy a new machine. All right. So if you buy the new machine, the problem says that you're going to incur like a cash savings each year. You're going to save on the time required to wash clothes, and your labor cost is going to decrease. So the first year, it says the investment is expected to provide you with an additional $140,000 cash inflow. All right. So that's a cash inflow. And for the next 2 years, it's going to give you an additional $270,000 cash inflow. So for this problem, it's assuming a 9% rate of return. It's asking us what the net present value is of the investment if the company decides to purchase the new machine. So the problem says we can sell our old machine for $100,000, right? So that's a cash inflow. So we got a positive sign. It's cash inflow. We can buy a new machine for $430,000. It's a cash outflow, negative. But we also incur an additional $100,000 working capital expense. Think of this expense as an installation cost. So you buy the new shit for $430,000 and they install it for another $100,000, right? So if we look at this 100,000 positive, 100,000 negative, because we selling the old one, we getting 100,000. And then down here, we got this installation expense. These two cancel each other out. We're left with a negative cash outflow of $430,000. That's how much we're spending in year 0. When I say year 0, don't look at this. When I say year 0, before we receive any of these cash inflows that the problem talks about, we have to spend $430,000 year 0. Year 1, we get an additional $140,000. That's the cash inflow, positive. Year 2, we get $270,000 cash inflow. Year 3, we get the same, $270,000. Now we got to put all this shit in the calculator. So we're going to use our calculator's cash flow register. So it's an uneven cash flow. So we're going to use the Texas Instrument BA2 Plus calculator, and we're going to use the uneven cash flow register function. So we're not going to be using these keys. We're going to be using these. All right. So first, I'm going to let the calculator know that I'm going to enter a cash flow. All right. So when I get to this function here, when I get to this screen, I want to make sure I clear out any previous work that I've done. So I'm just going to hit second clear. All right. So the problem says that we're assuming that the cash inflows are going to happen, are going to be recognized at the end of the year. So my cash flow at 0, that's going to be the cash flow before you receive those additional inflows. And that's going to be my negative $430,000 that I'm spending on the actual machine. All right. So we're spending out, for the company is, spending $430,000. So I'm going to hit enter. I'm going to hit the down arrow. It's going to say cash flow 1. The first cash flow, the problem says we're going to receive is $140,000. All right. That's the cash inflow. So it's not going to be negative. It's going to be positive. CO1, cash flow 1, is going to be $140,000. And I hit my enter. If I hit my down arrow, it's asking me what the frequency is of that first cash flow. How many times am I going to get that? And the problem says we only get that for the first year. So it's just going to be 1. Enter. I go down, it's going to ask me for my second cash flow. The dollar amount for my second cash flow is going to be $270,000. And that's a cash inflow, so it's going to be positive. I'm going to hit enter. And that's my second cash flow. It's asking me for the frequency of the second cash flow. All right. So we get this 2 times. So I can hit enter here, right? But just for the sake of showing you the cash register function, I'm just going to say this happens once. And I'm going to enter that cash flow again. All right. So we can hit 2 because it happens twice. We get that for the second and the third year. But I'm going to say 1. And then it's asking me for my third cash flow. So now I'm putting in 270,000 again. That's my third cash flow, frequency 1. So it's the same as saying that we entered that second cash flow twice. So the problem is asking us for the net present value. So if I hit this NPV button, which is the net present value button, it's asking me what an interest rate or what required rate of return I'm assuming. So I'm going to say 9 because that's what the problem gives us. And I'm going to hit enter. If I hit the down arrow again, it says net present value, and I'm going to hit compute. And our answer here is $134,183.50, right? So the answer choice, the first answer choice is going to be the one that we would go with to answer this problem.